A company's annual report, it can look like this, just dense sea of numbers, right? But it's actually so much more than that. It's a story. Seriously, think of it like a biography, but it's written in the language of finance. And just like any language, it's got its own grammar, its own rules. If you want to follow the plot, you've got to know the rules. So let's learn how to read it.
I bet that feeling is pretty familiar. And if it is, you are definitely not alone. The story these reports tell is really powerful. It can show you a company's health, its whole history, and even its potential future. But to unlock all of that, you first need to meet the main characters.
Right, so every great story needs its characters. In the biography of a company, the main characters are all the valuable things it controls, things that are expected to make it money down the road. In the language of finance, we have a name for these: assets.
To put it simply, an asset is just something valuable the company owns or controls. And this could be, well, almost anything, from the cash sitting in a bank account to a giant factory or a whole fleet of delivery trucks. The really crucial part is that it's a resource that's supposed to help the company create value in the future.
Okay, so here's where it gets pretty interesting. Assets aren't all the same. They're split into two big groups. First, you've got your tangible assets. That's the physical stuff you can literally go up and touch, like a machine or a building. Easy enough. But then you have intangible assets. These don't have a physical form, but wow, they can be unbelievably valuable. We're talking about things like patents, trademarks, or this really cool concept called Goodwill. So, get this. When one company buys another, Goodwill is the extra price it pays on top of all the physical stuff. It's supposed to represent all that invisible value, like a killer brand reputation or a super loyal customer base. It's basically the company's future potential all bundled up into a single number.
So, we've met our characters, the assets, but their story isn't static. It doesn't just sit there. Their value changes over time, and that's where the plot really starts to get going. Let's dig into how this story builds. One of the absolute key plot points for any tangible asset is something called depreciation. Now, I know that sounds super technical, but it's really just the accounting way of showing an asset is being used up over its lifetime.
I mean, a delivery truck can't run forever, right?
Depreciation is how the company's story shows that gradual loss in value as the truck goes out and does its job day after day. And this is a brilliant example of the most common way to calculate it. Just imagine a company buys a big machine for $1 million. They figure it'll be useful for about 10 years. With the straight line method, they simply reduce its value on the books by the same amount every single year. In this case, that's $100,000. So after year 1, it's worth $900,000, after year 2, $800,000, and on until its story in the financial books is all done. Okay, this is where our story gets a really fascinating twist. See, a company's biography isn't just about what's already happened. It's also about what might happen. So how in the world do you tell a story that has to deal with an uncertain future?
This is the perfect example. Let's say a company is staring down a major lawsuit. They might have to pay out millions, or they might win and pay nothing at all. They just don't know for sure. This is a huge unknown, a potential plot twist, and the rules of financial storytelling have a very, very specific way of handling it.
The very first thing they do is assess the odds. Accountants classify these uncertain events into 3 buckets based on how likely they are to actually happen. If it's probable, and that means there's more than a 50-50 shot, it's taken very seriously. If it's just possible, or if it's remote with less than a 10% chance, well, the rules for telling that part of the story change quite a bit.
And here are those rules, laid out plain and simple. If a future liability, like that lawsuit, is considered probable, the company has to record what's called a provision. That means it hits their main financial statements and shows up as a likely expense. But now look at the rule for a potential asset, say an insurance payout the company thinks it's going to win. Even if getting that money is probable, they can't record it as income. They can only disclose it in the notes. You can think of that like a little footnote in the biography, telling readers, hey, this good thing might happen, but not making it part of the main plot just yet.
So the crucial takeaway here is this fundamental principle of caution or prudence. Financial storytelling is conservative on purpose. It forces a company to prepare for the worst by recognizing potential bad news early. But at the same time, it stops them from getting ahead of themselves by booking potential good news before it's basically a sure thing. And this is so important for investors because it helps stop companies from puffing up their numbers and painting a picture that's way too rosy.
All right, now for the climax of any business story, making money. But you know, even this happy ending has its own strict set of rules. Recognizing revenue, which is just the money a company makes from its sales, is not as simple as waiting for the cash to pop into your bank account. To make sure every company tells this part of the story in the exact same way, there's a global 5-step model, and it goes like this. Step 1, you identify the contract with your customer. 2, you pinpoint every specific promise in that contract. These are called performance obligations. So, if you sell a phone with a 1-year service plan, that's 2 separate promises, the phone and the service. 3, you figure out the total price. 4, you have to split that price between each of your promises. So how much is the phone worth versus the service plan? And finally, step 5, and this is the big one. You can only recognize the revenue for each promise as you actually fulfill it. You can't just claim it all at once.
This quote just nails the core idea of that whole model. Revenue isn't about when you get paid. It's about when the company earns the money by handing over the promised goods or services to the customer. So, going back to our phone example, the company recognizes the revenue for the phone right away, but it can only recognize the revenue for the service plan bit by bit, month by month, over the whole year. That's the moment the climax of the sale truly happens in the financial story. So, we've looked at the characters, the plot, the twists, and the climax. But what is it that holds this entire story together and makes sure it's a language that anyone, anywhere in the world, can actually understand?
That's where accounting standards come in. You should think of rules like the International Financial Reporting Standards, or IFRS, as the universal grammar of finance. They are the official rule book. They make sure that when one company tells its story, it's following the same principles as every other company. And that allows investors, analysts, and really anyone who's interested to read them, understand them, and most importantly, to compare them fairly.
And that brings us to our final thought for today. These rules give us this incredibly powerful framework for understanding a company's journey just by looking at its numbers. But a story that's told only in numbers can never be the whole story, can it? I mean, what about the culture of innovation in its labs, or the morale of its employees, or the fierce loyalty of its customers? All of those things are incredibly valuable, but they don't always fit so neatly into the accounting rulebook. So I'll leave you with this. What parts of a company's real story do you think the numbers might be leaving out?